Good morning, everybody. This is Guild Investment Management. It's June 30th, and this is what we hope is going to be becoming a regular Zoom call. This one, there's a lot to talk about. We called it What Comes Next, More Pain, Fed Blink, Fierce Rally, Market Bottom, and What is an Investor to Do? Here are some general disclaimers. All of you are going to receive a link to this call and a copy of the slide deck, so you can read these disclaimers at your leisure when you go through the slide deck. You can see all of this on the call today. Monty Gill, founder of Guild Investment Management, Tony Danaher, the president, and I am here as well, Rudy Von Obeli. And this is who's going to be on the call today. So I guess I'll pass the baton to Tony to get started. A little bit of reflection on what's happened so far this year.
Hello, everybody. Well, the first half of 2022 is the worst year. They're saying the worst year for the stock market since 1970. And, you know, it's this historically bad stock and bond market action typically resolves itself because it's happened so quickly. But what we're going to do is we just have to evaluate all the possible trajectories from here, what their likelihoods are, assessing the current events, examining the historical precedents, and applying analysis and judgment when we make investment decisions. It's really all you can do. You're not going to necessarily be able to get all the data you need today at the end of the first half of the year to make the decisions for the rest of the year, but we'll give you an idea as to what to look for. Just overshadowing all things right now, you've got commodities have done well, gold has done poorly, and these data points here where you can see how various markets have done, those were as of last week, and stocks, emerging markets, developed markets, the S&P have gotten considerably weaker since this chart. The bottom line is liquidity has been receding this year as people prepare for higher interest rates. And then they go from preparing for higher interest rates because of inflation to worrying about recession. And that kind of double whammy is why you're seeing large, rapid declines in almost all asset classes, except for commodities. But commodities in the last week have really lost some of their early year gains. So that, you know, the biggest question I think people who are invested in this market are wanting to know is not necessarily when it will bottom or is it going to bottom, but how much more pain do I have to endure? And there are bearish factors at play here. The high inflation is likely remaining elevated. Even if we are at an inflationary peak reached sometime in the first half of 2022, the inflation levels going forward are higher than most investors are used to. And because of that, you got rising interest rates and decreasing liquidity. Central bankers around the planet are trying to address that inflation with the tools that they have. And getting inflation under control means tightening liquidity, selling assets if they have assets on their balance sheet, raising the cost of money, and the availability and cost of money is what drives asset prices. Geopolitics in Europe and Asia in particular, there are elements there that are causing large declines and worries about recession, worries about business. Supply chain keeps coming up as an issue, and those are geopolitical movements that markets and companies are having to deal with, hurting earnings. And these are the things that have gripped people today at the end of the second quarter and make them fear that there's more pain in front of them. In a lot of commodities, you have insufficient production and capacity, and that's caused large increases in food commodities, initially energy commodities, and that is raising the cost. It's raising a level of anxiety among consumers, and that's another problem. That is leading into this pain. How much more pain is there? PE ratios for the market leaving the pandemic 2021 infusions of liquidity reached absurd levels. They've been correcting now for about 18 months, 17 months for many of the highest high flyers, overvalued things. They peaked in February of 2021 and have been going down since. But still, the overall market PE ratio is relatively high based on history and needs to come down to norms. And when market PEs, what they call fair value, or what's a fair valuation, it never goes there and stops. It overshoots to the downside, and that is what people are worried about right now. Company profit margins, the PEs, the E in that PE is corporate profits, and profit margins are being squeezed by higher costs and not significant pricing power in their business. So they're paying higher costs. Some businesses are choosing to pass it all through to the customer and dealing with demand destruction and lower customer activity. Others don't want to give up the customer market share, and they're eating some of those costs. We've seen some retailers and some businesses have decided to do that, and that's a risky bet. In the meantime, they're going to have to eat those margins, lowering their earnings, and that makes the stock price fall as the PE look, as investors look for that fair value. What is a fair PE? And then domestically here in the US, we have midterm elections in November, and there was a set of expectations about how those elections could go. Lately, those bets on what the outcome will be like are being thrown around and mixed, and that anxiety, it's not necessarily political turmoil as much as it's political uncertainty, and markets don't like uncertainty. In uncertain times, markets trend lower. So those are the pain cases. Why don't you go to the next slide, Rudy? And Monty's I'm gonna hand it over to Monty here, and he's gonna focus on some of the inflationary factors, because that is at the crux of a lot of these issues the markets are dealing with.
Hi, everybody. First, I'd like to point out that inflation is likely to remain elevated. The CPI, which stands for Consumer Price Index, will begin to drop this year, but will likely be at 5% or more in 23 and remain at over 3% for decades, probably at least till the end, for years until the end of this decade. Important piece of data. You're going to see all kinds of conflicting inflation statistics from the government. Consumer Price Index is the one to look at. Producer Price Index, or PPI, is just what wholesalers and retailers have to pay for their raw materials. And these other ones that have been utilized by the Fed and other agencies in the government over the last few years are basically smoke screens to try and understate what the inflation rate really is. And the guise is, oh, we're getting more granular detail. The reality is they're less accurate. The fact is that you look at your credit card bill, and that's more accurate than what the government tells you about what the cost of living is. Global central banks are aware of inflation, and many are politically hamstrung in their responses, but still they're raising interest rates. Many, not 1 or 10, 20 or 40 global central banks have raised interest rates this year. And they are politically hamstrung, so their interest rate increases, which have been too low for too long, their interest rates have been too low for too long, the increases will not be as robust as needed. Next, commodity production and investment in capacity are insufficient. A great deal of this inflation that we have today has been caused by a lack of supply of goods and services, because government has disincentivized capital formation and incentivized handouts to consumers. In order to give more handouts and get more political plus points, government has made massive mistakes over the last few years, and now we're paying for it with inflation. Next slide, please, Rudy. Deflationary factors. Of course, interest rates will rise, and the Fed's job is to increase them until they exceed the CPI, Consumer Price Index, and therefore create a recession, a disinflationary environment. They talk about how they don't want a recession at the Fed. Of course they don't, because they're politically connected. But the reality is they're going to have to create one to get the effect they want. If they don't create one, they won't get the effect they want, and we'll have a moderate recession now, followed by another stock market rally for a year or year and a half, two, and then another much worse recession. So if they want to do the wise thing, they're going to take the medicine now. Central banks worldwide are draining liquidity. That means they're selling the bonds they've been buying for years to keep the money flowing to their economies. In 1980, when Paul Volcker did the last big tightening and took interest rates on the prime from 15% range down to normal ranges, the prime meaning the prime rate, which was a widely used rate in those days. He did that in a period of very low government debt, very low debt in the hands of the public, very low leverage employed by corporations. Today is just the opposite. Highest debt for corporates, for government, and for individual families in 30, 40 years. That's much harder environment in which to raise interest rates. Pain creators. PE ratios of many stocks are too high, as Tony said. Getting inflation under control will take time. It's a 4 to 6 quarter process. That means a year to a year and a half to begin to get inflation under control. As a result of that, the profit margins of companies and earnings of companies will fall. PE ratio stands for price to earnings, and earnings will fall even as revenues rise nominally due to inflation. If you're selling a t-shirt and you sell it for $2 and all of a sudden you raise the price to $2.50, you're going to show higher revenues per unit, but the number of units sold will fall. So the rise in revenues will not be represented in the entire cost curve, and the entire company profit system will be falling. With higher PEs falling to lower levels and earnings falling to lower levels, you have to be very careful about what you own, what industries and what companies within those industries. And that's it for me. Tony, would you take over?
I'm going to pop in for 1 second, Monty. So there were a lot of the reasons for pain and a lot of the sort of fundamental economic things that are going on right now, but that is not to say that during a bear market, which we're now in, by the official and kind of arbitrary measure of a 20% decline, we just want to point out that bear markets are the place where some of the fiercest rallies happen. And this is one item. So we were reflecting back on the dot-com crash, and during the dot-com crash over a prolonged period of time, there were multiple, I think I read 5 20% plus rallies during that time period. So a lot of the fundamental economic news and monetary news is tough. However, there are a number of catalysts that could support strong rallies later as we advance into the year. So inflation data could begin to moderate, showing a peak, which, as Monty pointed out, that doesn't mean that inflation isn't going to remain elevated and persistent for a very long time, but we still might get data that show us that a peak is here, and that might revive some animal spirits enough to cause an upward squeeze. There may be an improvement in the situation in Russia and Ukraine. I saw news this morning that Russia was making moves to ease some of the shipment of grain from Crimean ports. And of course, the Ukrainians say that it was because of the military victory of theirs, and the Russians say it was out of the goodness of their hearts. But for whatever reason, it's one sign that there may be an easing in tensions. And pragmatism would suggest that some solutions or easing might come online at any time, which could also occasion some market optimism. Economic activity in China could pick up. earnings season could begin and forward guidance might not be as bad as people had expected and had begun to price in. This is always possible as well. And again, with incremental data points coming in on inflation, we could start to get messaging from the Fed suggesting that they are satisfied or pleased, or they view progress as against inflation as being positive. All of these things, even if they're not addressing some of the deeper underlying issues that are at work, could well be enough to shift market psychology to result in one of those bear market rallies, or indeed multiple bear market rallies. So that's all worth bearing in mind as well. So the question, Tony, if you want to take this,
Sure.
how can we begin to anticipate a market bottom?
Right, and even if it's a prolonged bear market that lasts several more quarters, and you get those fierce rallies, one of those fierce rallies is going to come off of the eventual bottom. And a market bottom, what should you look for? The most important catalyst is liquidity, and the Fed and the central banks around the world are still reining in excess liquidity. How far can they do that? How long can they continue to do it? How much pain are they willing to cause? And this gets to the question, and why you have to be ready for the bottom before the ultimate change in policy takes place. So currently, liquidity is being withdrawn by central banks. They're going to likely need to see more progress on inflation, i.e. economic demand being squashed before they reverse course. But their reversing of course could come at a point several months after the market bottoms, and Monty will talk about that. The market will bottom before they do. And so you want to be alert that this price weakness we're seeing in the market is signs that it's perhaps being overdone. Look for signals, look for things that make sense here at these levels, with the idea that the duration of this tightening cycle is not going to be as long as the 1970s tightening cycle because of the level of debt in the global economy. The central banks do not have the stomach for that. Go on to the next slide, Rudy. Thank you. So this Fed blink that we're looking out for, the Fed blinks and the central bankers around the world hit the point where they can no longer comfortably tighten. And you watch credit spreads, you watch the labor market conditions. These are the tells in which the Fed is not likely to be, and the central banks are not likely to be tight. They're currently talking tough. They're willing to risk recession. There's a lot of that messaging. Much as the messaging that's come from the Fed since November of last year has already done a great deal of work for it in terms of decreasing demand and reducing, consumer behavior. The blink isn't going to be caused by stock market turmoil or from recession, but credit markets and from labor markets. That'll be the true test where the pressure is put on the Fed to stop, loosen up, because labor market stress, credit market stress are far beyond what they're hoping to do. They're just trying to get price controls. They're not trying to kill credit and labor markets. Their own dot plot, suggests, and this is all the Fed's voting on what the interest rate curve will look like in the next couple of years, suggests that the average sees them peaking at 3.8% next year. And that is a series of, over 200 basis points additional tightening coming. But it's possible they don't even get that high. There are a couple of Fed votes that see it over 4.5%. And if you go to the next chart on the next page, you see that dot plot. If these are the votes for the next 2 years, you can see the peak averaging 3.8% is in 2023. It's next year, and we're 6 months away. We're getting to be 6 months away from some of these peak these peak interest rate numbers. And then one thing you have to remember, and Monty will go into it before, is how often the market usually bottoms and is moving up in advance of the peak. So these are the Fed votes. You see a couple of outlier votes, by the several Fed members that are over 4%, but most of them are 3.5 to 4 before it starts to turn lower. If you were to ask global market participants on the next slide where they see interest rates, and these are not political, these are portfolio managers, these are market participants, these are corporate treasurers, and they have their own view, and they don't see interest rates in the US being able to get that high, 3.8 or 4, because they see a turn in Fed behavior. These are people that they're not making the decision, but they're closer to the actual numbers of the economy. They can see what's happening, and often they can see it before the Fed gets a look at the data. So this is an amalgam of opinions, the consensus that the peak in interest rates is, if you go by this chart, is less than 9 months away. And so you can't necessarily be waiting until then to buy. Go ahead, go to the next chart, Rudy. So waiting for the blank.
Which one were you looking for, Ted?
Go ahead. Just the next chart. Can investors wait for the blank? And Monty's got this axiom that holds true about the market being a discounting mechanism. That is absolutely true. And the cessation of the Fed tightening will come after the market has bottomed. It's well off its lows. The number of months in advance, you want to be ready. You want to have positions. You don't want to be completely out of the market at the bottom. You don't want to necessarily be completely out of the market when the Fed turns, because you'll have missed a lot of the moves. So there's work you can do as an investor to find investments during this period while things are getting cheaper, to be ready for that rally. If it's a bear market rally, as Rudy discussed, or if it's the ultimate bottom, this next big rally, the question is whether or not those two previous charts don't roll over as expected. Do you not get the rollover in the dot plot because the inflation numbers are staying high? Do you not get a rollover in market participants thinking, oh, this has got much further to go? That's when you go from this next rally being just a bear market rally, we've got more work to do, to being closer to the bottom. So if those charts are accurate or close to accurate, we are less than a year away from the peak inflation, or the peak interest rates for this cycle.
Most professional investors of quality experience understand that the market is always looking ahead 6 to 18 months. Even in a time like this, when there's great uncertainty, they're looking ahead 6 months. Almost every seasoned investor I know, and I know a lot of them, says that they don't think the Fed will be able to get inflation all the way down on the first try, that it'll be most likely that they get some correction in inflation, but it'll still be remarkably high on historical level, over 5%, when they begin to pump money into the system again because of their fear of lack of liquidity in the system and the political repercussion. The cessation of liquidity tightening and confirmation that central bankers are making an about face comes well before the market, before the Fed has changed in the market. It comes 6 months ahead. The rally that could derail if inflation does not come under control, that Tony just talked about, sets up for a second squeeze in 23 to get inflation down before the 24 election. This is why it's important to the administration and the Congress to get inflation down this try, because it's going to be much, much more difficult to do it closer to the big election in 2024.
Thanks, Monty. So I guess this brings us to the chase. What do we think there is to do at this juncture? So we're obviously in favor in situations like this of holding cash balances, because that allows for optionality and allows to take advantage of opportunities. some of those bear market rallies can be opportunities to raise cash if you need it. But as we always emphasize, don't give up on equities. Even in inflationary environments, equities throughout the world historically have always been a line of defense against inflation. If nothing else, simply because of nominal price increases. So with that said, what we're doing and what we suggest investors should do is, first of all, to look for companies that are selling and producing necessities. So the pandemic era was an era of explosion for hopes and dreams companies, so to speak, and for the total change of the world that all of us hoped and or feared might be happening in 2020, but of course didn't turn out quite to be happening as everybody hoped and feared it might. So necessities are back on everybody's radar, particularly with supply chain disruptions and everything else, and the move from just-in-time logistics to just-in-case logistics, although there are inventory curses that are happening as a result of that as well. But necessities such as energy, food, important components for the fourth industrial revolution, rare earths, and battery minerals and such things. Look for companies with good earnings yields. That's the inverse of the price to earnings ratio, and or high dividend yields. Those are things that you can begin to get positions in before the bottom. And as usual, our mantra and our basic philosophical orientation, which is the same as it has been forever since the founding of the firm, is the GARP mantra: growth at a reasonable price. So a low PE ratio and high growth, because you don't want to get stuck in value traps that have low PE ratios and are always going to have low PE ratios because they have good growth. In an era of rising interest rates, balance sheet strength is important. So this isn't the time to go exploring into highly leveraged situations. We think that a time is coming when the boost to indexing that was created by all of the QE from 2008 crisis through the pandemic QE, all of that QE served to lift broad indexes indiscriminately as money flowed in. And we think it's likely that that situation is going to begin to change. And there is going to be more differentiation between in sectors, industries, and individual companies. So we think it's important to focus on sectors and industries that can grow and on individual companies that can grow and their idiosyncratic characteristics due to management, due to their positioning, due to intellectual property, due to execution strength, and all of those factors. We think those things are going to be able to outperform the broad indexes, and we may be entering a situation where the broad indexes move very sluggishly for a long period of time, but within them, there will be sectors, industries, and companies that can outperform. So we would suggest to look for companies that have fallen in price, and that's the gift of a first half of the year, as brutal as the first half of the year has been in 2022, is that value gets created. And if you have the agility and the means to take advantage of that, you can look for the companies that have fallen in price but are gaining market share through innovation. We talk about GARP, but the growth that we're talking about often has to do with innovation, medical innovation, software innovation, semiconductors, the fourth industrial revolution, as we say, shorthand for artificial intelligence and cybersecurity and the Internet of Things, automation, business digitization. All of those things that were accelerated by the pandemic are still real, even though many of the companies that saw their stock prices go up absurdly as a consequence have seen them come down again just as hard. The technological shift that's underway is still real and is still ongoing. And at some point, some of those companies are going to present attractive bargains for investors again. One thing that a more bespoke advisor such as us has to offer that larger advisors are more challenged in offering is diversification to commodities. Commodities are difficult, as we've seen with energy recently, which performed so strongly early in the year and has had a much harder go recently. Commodities can be very volatile, but in the medium and long term, the fundamental factors that Monty and Tony pointed out above about the lack of capacity investment suggest that in the medium to long term, commodities are going to take on a renewed importance. And as the world, I think of Europe experiencing the concrete effects of its dependence on Russian energy and the political consequences of that, and the German politicians are beginning to sound like Jimmy Carter, talking about taking 2-minute cold showers because they don't want to be dependent on Russian gas. And by the way, it's the middle of summer right now. So the much maligned and much hated legacy hydrocarbon energy sources are medium and long term worth looking at, as well as the new energy sources, lithium and so forth. And if the dollar is rising, U.S. real estate is another area for diversification as well. The second bullet point here is a little more, getting a little more into the weeds, but central banks do make mistakes. Historically, it is a non-trivial and non-zero probability. We think it's a very low probability. We're fond of saying that the US dollar is the cleanest dirty shirt in the laundry, and that is still very much true, and there's no real sign of that changing anytime soon. And with all of that said, some fiat currency debasement hedges, such as precious metals, and indeed, although it's a very different kettle of fish, some digital assets, those are worthy hedges. And last but not least, of course, we say stay away from bonds. 2022 has been a nice illustration that the great growth of the 60% stock, 40% bonds indexed portfolio has been largely perhaps an artifact of the easy money policies of the post 2008 era. And for the very long end of Treasury, the Treasury market is down even more than the stock market this year. So the 60-40 portfolio has performed very poorly. For those who have to own bonds, of course, we would say stay shorter term and reduce the duration of your bond portfolio and look for positive real returns in an environment where inflation is persistently high. So that was quick. Does anyone have anything to add to that, or shall we move on to some questions, because we've got some questions from listeners.
Sure.
Okay. So the first one is on banks. Maybe we could offer a little bit of opinion about big bank stocks, regional bank stocks, what their prospects look like under current conditions, if anything general can be said. Thoughts on that?
Marty, you want to start and I'll pick it up?
Okay, banks basically make their money. Banks make their money by making a spread. And when interest rates are rising, many people think banks will do better because their cost of capital raises slower than the rates they're charging. This is very true in the old system. Banks, in the meantime, especially the money center banks, have widely diversified. They're no longer the same institutions whatsoever. They basically are in the investment banking business, the brokerage business, trading bonds, trading stocks, trading commodities, general lending, apart from credit cards, varies from bank to bank. Credit cards are a big part of the big money center banks. Therefore, when a recession comes, it's not good for the money center banks. It's not good for the massive banks, and it's too early to buy banks. If you do buy them, wait for lower PEs and lower earnings because they will be coming. As far as specialty banks, especially mortgage-related banking, which has been taken away from the savings and loan industry with the savings and loan crisis of the past century and with the crash of 2007, 2008, when there was a lot of fraudulent real estate lending. New regulations came in and some commercial banks picked up savings and loan regulatory activity. Tony, would you like to talk about those?
Sure. And there, so you do have banks with lots of businesses. Some are heavily in mortgage, as Monty said. Some are heavily towards the consumer, some commercial, some are equity market. And at this time, I think the question was, is it too early to buy banks? The premise for owning banks up until the recession fears really started to take hold made some sense to investors if net interest spread, net interest margins were expanding. But as soon as it became clear that the economic activity is starting to roll over and a recession is more likely, all of those businesses, whether it's mortgage, consumer, business lending, capital markets, they're all pressured. And so you really need to buy banks. You need to see that this is not going to be a deep recession. If it's a shallow, short one and they muddle along, perhaps some banks get cheap enough to own, but in general, it's not an area where you want to go prospecting right now. There are other faster growing companies that will be able to turn those faster growing revenues into profits better that have fallen enough. There's just better merchandise out there for this environment because the banks of all types have issues.
Great. Thanks, Monty. Thanks, Tony. Question on gold. The dollar has strengthened a lot, but gold has not moved down too much. Why is that? What accounts for gold's price action?
May I take that to start? In the 70s, the big mover of gold, the big producer of profits in gold was the result of stagflation. You got inflation up around 10%, and then it just stagnated there for a few years. When that happened, the phones were ringing off the hook here. How do I keep ahead of inflation? I'm not getting anywhere near 10% on my mortgage, on my bank deposits, on my bonds, on my dividends. How can I make money in that kind of an environment? In that kind of an environment where people lose confidence in the rationality of the government, in the value of the currency. And at the same time, the US government was letting the dollar fall, which caused gold to go up quite a lot. This time is slightly different. Gold has a competitor, Bitcoin and cryptos. Although they've shown to have feet of clay in many regards, cryptos are an alternative to gold in the sense that they are portable, they can go worldwide, they're very useful in countries where corruption is great, and you want to avoid the long arm of the corruption which exists throughout the economies in many parts of the world. As far as this time, the US government has wisely, one of the few wise things they've done, caused the dollar to rise by being proactive in getting interest rates up. Other countries like Europe have been very slow in the European community to raise rates because they're loaded with debt. And when people are loaded with debt, they don't want to raise rates. So the US can see some rally in gold during a stagflation, but it will take a loss of confidence and a decrease in the dollar as the dominant currency in the world. As the dollar is rising and people see it as the dominant currency in the world, which is definitely happening at this stage, that puts pressure on gold. It doesn't mean that you can't buy gold on dips, because buying gold on dips has worked. But it does mean don't make gold the centerpiece of your portfolio.
Good, thanks, Monty.
Thanks, Monty. And with respect to gold, it's a unique asset. It's not an asset that gets much placement in large institutional portfolios. And something needs to change there for it to be, move as high as some people think it could. And it's entirely possible that, institutional portfolios could start to hold more gold. Right now, the buyers of gold are central banks, and it's just a narrow number of central banks that have been heavy buyers supporting it. I think the question was, the dollar has risen, why hasn't gold fallen? You could also say that given the fact that inflation is moving up from such low levels and where it is today, why hasn't gold risen? It's really been caught in a tug of war, and its placement in portfolios and its placement as an investment decision is under review. And Monty is right. Stagflationary environments, gold tends to be one of the best consistent performing choices in a prolonged stagflationary environment.
Thanks, Tony. On crypto, we have a crypto question. Is crypto a buy, or does it have further to fall? I'll opine on that. My initial response is yes to both parts of that question. It probably does have further to fall, and I think it's. It's important to remember that Bitcoin was at 5,000 before the pandemic hit, and it spiked up to almost 70,000, and it's come down to about 20,000. And it's a very young asset class that still tends to trade very much with liquidity, with risk on sentiment, with high beta tech stocks, with all of that stuff. Still largely, that's probably 90% of its behavior. 10% of its behavior is edging in that hedge for fiat currency mismanagement. And it's not the bulk of it, but it is beginning to happen, and that process may accelerate. So my take is nibbling and holding what you've got is a thing that you can do sensibly. I would not be backing up the truck just yet, but I would be watching. And the other thing. Go ahead, Tony.
Rudy, that's specific to Bitcoin. I mean, there's a lot of garbage in
that's my next point. My next point is, the question was, is crypto a buy? And to that, I have to say no. Some digital assets may be a buy, but if we've learned anything from some of the misadventures of the past little while, Monty always just shakes his head and says, this is how these are the characteristics of unregulated financial markets. This is the way this stuff works. You get fraud when there's the opportunity for fraud. So there are just a vast plethora of crypto projects out there that are weak, if not outright fraudulent. And so to say buy crypto on the whole, absolutely not. Due diligence is more important here is as important here as it is anywhere else. And yes, Tony, I agree. Personally, I think the strongest case is to be made for Bitcoin itself. Intellectually, I see some of the benefits of DeFi, but I question how much of that is going to actually result in speculative gains for people, and how much it's just going to get subsumed by the existing financial system. The hedge aspect I see as a Bitcoin phenomenon.
Right, and it's a hedge or insurance policy against a low probability of cases.
Yeah.
So you don't have it be a large part of your net worth, a large part of your portfolio.
Correct.
Because the probability where it really shines, where the people that are talking about Bitcoin changing the world and its maximum utility is only achieved in a deep, dark place for
in a situation you don't want to see. Right.
That's right. That's right. But a small insurance policy in your portfolio is fine.
Certainly.
But speculating on price is not worth it. Look at it as insurance. Trade it if you're good at it, but most people are finding out that they're not.
Right. Right. As they say, everyone's a genius in the bull market.
This brings us to a question that I've been asked. How does one identify a market bottom? Using economic variables, using technical variables, using financial variables. We would argue that it's a combination of things. We know that earnings will decrease in a recession. We know that PE ratios will decrease in a recession. We know that the PE ratio of growth stocks will fall when you get a stagflation. And we also know, based on historical precedents, looking back at all the bear markets and all the bull markets for the last 100+ years, there have been two major bear markets in the United States and in the Western world in the last 120 years. And those were in the 73, since the Great Depression. And those were in the 73, 74, 1973, 74 environment, where you had a serious recession, which was the second recession in a row after the guns and butter inflation of the 60s, caused by fighting the Vietnam War and doing the Great Society, had a very virulent, long-lasting inflation. They had a recession in 1970, which was the worst stock market decline for 6 months like this year since that time, since the Great Depression. Now we're having that again. They weren't able to get inflation under control entirely, and then they decided they wanted to impeach President Nixon over Watergate. The result of those two events, economic and political simultaneously, caused a major bear market in 1974 when the Dow Jones Industrial Average fell over 45%, when the small cap sector of the US economy fell by 90%, and when the average company on the New York Stock Exchange fell by 60%. That was a major bear market, and it led to an unprecedented rally in stocks, in gold, in commodities, in everything else that came out of that deflationary period. That created a huge period of opportunity that lasted from December 74, the day Nixon resigned and left the White House, all the way to the year 2000, with small intersections of decline in the middle. That was a wonderful period, and it was caused by political policies which were implemented to incentivize capital formation, increase the supply of goods and services available, stimulate the interest in venture capital, which provided the capital for that to happen, changing the tax law to incentivize growth and economic activity that was begun by Reagan, and in Britain by Thatcher at the same time. So Europe enjoyed the similar period. As a result of that, we had a very big boom lasting for decades, and we could have such a big boom again this time. There's no reason to abandon stocks and get pessimistic about stocks. But what we can do is we can look at the history. Most recessions go down 20% or more, and they last from 2 to 4 quarters. We believe this recession already began in January, and that the data will come out later showing that we've been in a recession if you use real dollars and not inflated dollars. The real growth of the economy has been down in the first quarter. The second quarter will probably be down in the third quarter. And by the fourth quarter of this year, latter part will probably be starting to move up. We expect that the inflation will come down to about 5% next year if we're lucky. If we're unlucky, it'll stay high a little bit longer. But that could cause us to have a good stock market in 23, 24, early parts. They don't want to have to put in another recession in 23 because inflation gets too high again. So they're going to have to do something about that. History teaches us 3 things. Buy when the market goes down 25% with part of your money. Buy when the market goes down 30% with a little bit more of your money. And buy when the market goes down 35% with the remainder of your cash. The market has so far fallen about 23%. And if you have 30% cash, like many of our clients do, we would suggest the wise course of action is to find the cheap, undervalued, forgotten stocks and buy part of the positions at down 25%, part down 30, and part down 35%. You never buy at the exact bottom, but by having stocks on the day the market bottoms, you will make 10% in that day. And in the first week or two after the market bottoms, you could easily make 15% or more on your portfolio. So we believe when others are fearful, as Warren Buffett is famous for saying, I'm optimistic, and when others are optimistic and greedy, I'm fearful. Right now, we have a period of great fear. This is a time to get more optimistic. It's not a time to plunge in, but it's a time to prepare to plunge little by little, step by step, to take rational decisions to make money into the new wave of opportunity, which will surely follow this recession. So that's my view. Maybe Rudy and Tony have a different view.
They're very helpful. And just thinking about that differentiation we tried to make earlier between a bear market rally and in a long, stagnating environment like the 70s versus the bottom. You don't know at the time. But even that bear market rally that you talked about, Monty, from 1970 before it started rolling over again in 1973 was a 60% move in the market from bottom to top. Before it fell a lot again.
And it
lasted. And it lasted over almost a year and a half. Right.
So you could have a year and a half.
You want to be, you want to be alert. And given the carnage in the marketplace that we've already experienced and all the fears that we spent a lot of time talking about, the fears that people have, they're real. It's from these environments that bottoms are created. It could last. We still have some tightening in front of us. There's another Fed meeting in 3 weeks, 75 basis points, 50 basis points. There's going to be some messaging delivered by the Fed between now and then. The data point we got today from the Fed's favored inflation gauge, the PCE, that particular measure showed a decline from the prior month, which is a decline from the prior month. So it looks like peak inflation is possible to become a discussion point. And as people talk about peak inflation, their whole tenor and tone could change and make the market start acting better. We're not calling it that the market's going to race higher because there's still some more things that the Fed has to do. And this draining liquidity cannot be underestimated for what it can cause. But we're looking for some of these things that have been thrown away. Companies taking market share, as Rudy said, good balance sheets, companies that have already fallen, and their nominal revenues could go up if they have pricing power. We're doing our work. We're going to be on a series of conference calls throughout the month of July as companies report earnings to try to parse out the information and pick the best areas of the market for this next rally that is going to come. Don't want investors to think it's never coming.
One last point that I'd like to mention is that I got a notice this morning that the U.S. is talking about increasing their commitment to NATO from 30,000 troops to 400,000 U.S. troops in Europe as a result of Russia's claim that they want to reassemble the former Soviet empire and take over all of the countries that were formerly once part of their empire, including all of Eastern Europe. The US is talking about having a large contingent of NATO troops in Poland. This is a big change in the US defense spending. This is an area where new resources will be going, and this is an opportunity for many people making equipment for those troops. Body armor, helmets, protective gear of all kind that are also being utilized more by police forces around the world. So there are real opportunities being created by changes in the policies of the US government. Recently, the administration, which has been anti-growth of fossil fuels, had to admit that they're going to have their first lease sale of offshore oil and gas coming up soon, because we need to start producing more domestic oil and gas. The only other option is to produce more coal here, because we need self-sufficiency in energy. And quite idealistically and quite wonderfully, we all want to do solar and wind. And we know that long-term, those are our goals, and we all support those goals. But we must have a bridge process to allow people to grow food and eat and keep themselves warm in the winter and cool in the summer until we have sufficient solar and wind capability to operate without fossil fuels, which will be, according to realistic expectations, decades into the future.
Well
So
said.
that's for me.
Excellent.
Thanks, Monty. Thanks, Tony. I think that's the end of our stable of questions, so I will wrap it up for today. Thanks, Monty. Thanks, Tony. Thanks to all of you for listening. You'll be receiving this and watching it with a copy of the slide deck. If you have any questions about anything that we discussed, or you would like to discuss any of these items further, please feel free to send us an email or give us a call. We would love to hear from you. And with that, I will say have a great rest of your Thursday, and we'll talk to you soon. Thanks.
Thanks, everybody.